In the world today, there is still a lot of uncertainty about the direction of the economy, about inflation, and about politics. In such an environment, here are 3 strategies we will look to implement in our portfolios to navigate the year ahead. The first strategy is to have a global approach. In today's high interest rate environment, there are plenty of ways to build yield in fixed income, but there are risks within the asset class as well. For example, in some areas of the market, credit spreads are very tight. This is particularly the case in the US market, where growth has continued to surprise to the upside. So we'd suggest to focus on a global opportunity set to ensure that investors do not end up chasing yield in areas of the market where the risk-return proposition is unattractive. Meanwhile, in duration-sensitive parts of the market, particularly government bonds, curves are still inverted, so investors need to think carefully about their interest rate exposure as well. Our global mandate allows us to look across regions and take advantage of the increasing divergence in the pace of central bank policy changes. The second strategy is to focus on high quality. What exactly do we mean by that? It's easy to champion a high quality bias, but then to experience lower quality returns. Our credit analysts work hard to evaluate good quality credit investments, whether they are rated investment grade or high yield. We focus on the sweet spot in global credit, and typically that's in what we call the crossover space, with credit ratings that are low BBB, double B, or high single B. Through various credit cycles, returns in these parts of the credit market have tended to outperform the market overall. The final strategy is to be as unconstrained as possible. We think the best way to find value in the global fixed income space is to be able to look wide across the opportunity set, not necessarily at the largest, most liquid parts of the market, which have become rather expensive. One interesting area is structured credit, where CLO tranches that are very low risk have double or even triple the spread of the same rated paper in the corporate bond market. And another area is in high quality bank AT1, where yields, even in low risk banks, can be 50% higher than they are for senior paper. We think having a flexible, unconstrained approach is the best way to build a high income producing portfolio in 2025.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书或投资人须知。